Want to know how you can gain access to capital to jumpstart your journey to entrepreneurial success? For entrepreneurs who are just starting out or those who have been in business for years, Minority Business Access is your podcast. Welcome to our show, where we will guide you in avoiding the pitfalls and thriving in your chosen business. Now, on to the show with your host, Solomon Ali.
Wow. You know, again, this year starting off 2021, a really exciting year. We're only a few days actually into the year, but want to go ahead. My team keeps finding these amazing pieces of information, of other videos that's already so well done. I can't do it any justice. So the best thing I can do is listen to my team to share this information with you, give you my opinions on it. So that's what we're going to do today. Thank you all so much for joining in on Minority Business Access. Again, thank you for being on MBA and just taking a look at what we have, because guys, it will help you, and ladies too. I know everyone gets mad, but when I say guys, I mean everyone. So I guess I just should say everyone. Everyone, it will help you to navigate the fields and avoid those minefields. That much I can promise you, because you won't make the mistakes that I have made along the way, that other entrepreneurs and business people have made along the way. You'll be able to avoid some of that and get to your destination a lot sooner. All right, again, thank you for joining MBA, and we're going to watch the first video and we're going to pause it as we're going. Let's go.
Yes, I got a great webinar called Become Part of the 9% and on 91% lose in spread betting. And you've got to, there are so many things you would need to do to become part of the 9%. If it were that easy, everyone would be part of it. And there's a lot of intelligent people making up part of the 91%. And in fact, you will always vacillate. You'll be in the top one, and occasionally you'll be outside the 9%. But what you do need to do is you need to potentially decide on a strategy that looks after all elements of money management. And we've discussed the risk reward, we've discussed losses. You've got to manage losses, that keeps you in the game. You've got to believe you have a system that will make more than it gives back on its winning. It will win and will lose.
Let's pause it for a second. People, you don't get there. When we say a system, we're talking a roadmap. You have to develop a roadmap. And a lot of times that roadmap is not going to come just from your own creation. It may be your initial idea and concept, but now you have to pull information from other people who know a lot more than you to develop the roadmap. It's like when you're building a house. Think of, okay, you got your general contractor, but then he brings in the different trades, okay? And the different trade people come in. One might be the plumber. One might be the one framing the house, laying the concrete or the floor, putting on the roof. So you have all the different trades, and at the end, it's a what? It's a house. So think of yourself as the contractor that has to bring in all of these experts in to help you to finish your task. Okay, to get to where you're going. Your task is, hey, you're looking to make better trades, better investment. Now, what do I keep saying? You keep hearing me. If you're listening to me, you'll hear this. Look at the management team, people. Does the company have the potential of triple-digit growth? Is it in the right industry? Is the company reinvesting its money to grow itself? Those are very critical things that when you're making an investment into a company that's going to depict your returns. If that company is missing any one of those things within your formula, guess what? You're going to have lousy returns, or basically you're just playing a game of chance. So this is a way to eliminate the game of chance, okay? It's not 100% all the time. Okay, sometimes it's just gonna miss, because that's life, things happen. But for the majority of the time, if you're following those kind of principles right there, you're going to win. The other thing is that people always forget is this. There is a thing called pay your due, which is taxes. You must always equate that into your equation. Okay, Because when people say, oh, I got 50%, 200, 300% return, what does that mean? Because when I look at it, I'm like, okay. And after you pay taxes, you didn't get as much as you thought. Where if you would have held on to it for a year and 1 day, okay, yes, it may have rise up and down, but when you count in the tax benefit, you may have ended up with a much higher return. So those are the things that you got to be looking at. The other thing, people, look, I'm going to keep saying this. There are companies out there who are doing the due diligence, who are doing the research, pay the money to spend to get these analyst reports, to get an understanding of the company, of the industry, of the management, what's going on. Not only that, there's companies out there who are loaning money to these companies. If they're loaning money, don't you think that might be probably a good probability that they believe in the company and they have a reason to believe in the company? Because look, they have more resources than you do, right? So they can take their resources and do all of this work behind the scenes to figure out what's going on with that company before they invest their money. And when they invest their money, I mean, look, if Warren Buffett invests his money in a particular company, guess what? And I'm interested in that industry, I'm going to invest over there as well. It's that simple. Money normally follows money. So if I'm watching other people invest in things that's wealthier than I might have to go invest in that and do that too, because I know they've done some type of research. I know they just didn't throw it to chance, okay? But I don't follow people I don't know and understand, and I don't recommend you to do that neither. You know, if you have any questions, hey, look up SolomonRCali.info. Go there and you can see like what we're doing, the research that we do on companies. Hey, educational purpose, I ain't telling you to invest in anything. That's up to you and the companies that you find. But it gives you a good concrete idea of how to go about it so that you will end up on the top end and not in that 91%.
The time, no one is ever going to have 100%, so accept that losses are part of the game and manage that. Become as systemic as possible in determining what your setup is. So the more it can be reduced to logic, the better, and the tighter. And then you need to stick to the system as systemically as possible as well, which most people are incapable of with emotions, particularly after, say, 3 losses. You'll be snakebite fearful, and after 3 wins, you'll be piling on twice the size. And that'll be the one that'll lose and give back all of those 3 wins and some. So that's where focusing on, if you had to develop a black box system, is not a bad process for defining your strategy and that which you find interesting. Observing charts, a lot of observation, a lot of drawing of charts, and a lot of use of patterns.
A lot of you turn around, you're in a stock, and all of a sudden the stock is going down. You get emotional and you see everyone fleeing. You might even read a PR, and all of a sudden everyone's fleeing. You know, I kind of like what Warren Buffett said. When everyone's leaving, that's probably the time to be buying. That's what I do. If everyone's jumping out, okay, I'm not jumping out because everyone else is jumping out. I am probably going to accumulate more because one of the greatest investors that this country has known has said what? When everybody leaves, you should be going in and buying. Now, when everyone's buying, you should probably be doing what? Leaving. Here's the other thing that most people make. It's very common. And I did it also in my early days. In fact, I'm going to use Facebook because I did it with Facebook. It hit a number. It hit my number. And I said, oh, okay. I got in somewhere between $7 and $9. Around 38, I sold. It was too early to sell. So I took my money within probably about first 6 months or so. I took my money off the table. So that means I paid the short-term capital gains tax on that. But then here's my point. When you invest, think long-term. You should not be investing in anything that you're not willing to hold long term. And long term, people, is not 90 days. In fact, long term is well over a year. You should be willing to hold that investment, because that investment is going to go up and down. There's going to be some bad decisions by management from time to time. There's going to be some panic selling. There's going to be some analysts giving predictions and things of that nature based on their due diligence and investigation that doesn't match up. Okay? People are prone to be wrong. So you stay long term, and it allows everything to kind of settle. And that's what you're looking for. But you got to know that when you go in, hey, I'm going in here long term. I don't mind holding this stock for 3-4 years if I have to. It's great, okay, because I like the industry. I like the management. I like the company. I see the things that they're trying to do. They're solving problems for other people. You got to have the fundamentals down of knowing what drives a company and what drives their revenue, what drives the industry, what makes them disruptive in the industry. What is it that they're bringing new? When you know and understand those things, you can do this. Sit back with confidence in your stock picks, okay? That's what's important. So when you see the stock or some bad news coming out, guess what? You're not freaking out. You're like, oh, let me buy some more. Let me buy some more. And so then what happens is you start averaging. And so at that time that you're averaging, when the stock price starts to make its gains, they don't even at that point have to be significant gains. When they start making gains again, all of a sudden, because you have averaged, your returns begin to become greater. Most of the time, even greater than it would have been before. Let's go back to the video, and I'm gonna try to be quiet so we can listen to this guy, because he's really good and he knows what he's talking about.
Patterns. Patterns are probably the most powerful technical analysis tool for me outside of the larger trend Dow theory.
What are some trading mistakes to avoid?
Most trading mistakes made by beginners, even intermediates, and occasionally even advanced people when they lose their heads is to do with trade sizing. So they take a loss too big. There's no damage done in taking your managed loss. That's part of the game and being wrong. The problem is that recovery ladder when you then emotionally negatively respond to taking an already slightly bigger loss. So let's say you lose 15 or 20%, and then you think, damn, I want to get back to where I was, so I need to make 25%, so I'll trade bigger again. I'm sure I'm right this time. You can't cope with the mental, it's like a mental cognizance dissonance, cognitive dissonance that makes you need to get back to where you once were, because you're now seeing yourself as the lesser self as dictated by this balance.
See, he's talking directly to traders, but I need to break this down for you at Minority Business Access, for the people who are watching. The reason people get emotional and they say, oh, I bought the stock, it was at $15. And now it's at $17, $15, $8. The reason they get emotional and they panic is because of one simple thing. They bought the stock on emotion. They bought the stock thinking it was going to rise. They didn't know anything about the stock. They didn't know nothing about the management team. They didn't have the basics that they needed to know to make an informed decision, people. You must make an informed decision. That's critically important. Know the company, know the industry, know what they're doing, know why they're doing it. Critical. Otherwise, you're going to be an emotional roller coaster. Stock goes up, you're happy. Stock goes down, you're sad and depressed. Stock goes up, you're thrilled. Stock goes down, you're sad. To get off of that emotional roller coaster, know what it is that you're investing in. Be excited about, oh wow, This industry is new, it's growing, it's exciting. This company looks like it's going to be a disruptor. The company is adding new value where I see the first top 5 companies in the industry is not doing anymore, okay? Oh, management's got a proven track record in growing and scaling a business and things like that. Oh, they're reinvesting their monies back into the company for its company's growth and success. People, there's going to be some ups and downs, but when you understand what it is that you have invested in, you can hold your position with freaking confidence because you know what it is that you were investing in. So you're not looking at the stock price. Oh, wow, it's up, it's down. I don't look at stock prices every day. I look at the companies that I invested in. Once I've invested in them, I'm done. I'm riding it out. I'm in with them. I'm in for the win because I already know that they're going to win because I'm confident in the research of what I've invested in, the research that's been gathered. That's exciting. That's when you know, okay? That's what investors do. Otherwise, you're going to be one of these people jumping off the building because the dang thing went plummet. No, if it plummets, I'm not worried about it. I'm like, oh, okay, I better pick up some more before everybody else catch on to what I know based on what the research has revealed. Sometimes, like in life, just when we start things out, just because it's supposed to work a certain way, don't necessarily mean it's going to work out really great. There's going to be some up and downs. So if you follow what we're teaching at MBA, when you make a mistake, here's what you will not do. You will not get emotional and start selling or dumping, okay? Or you won't get emotional and start average when you shouldn't be averaging. You'll be able to stand your ground because you know that your due diligence that has been provided to you is rock solid. You know that you're standing on solid foundation. So you'll be able to hold your position with confidence. That's basically what happens when, hey, you make an investment and you're throwing caution to the wind. You don't know much about the company. You're just looking at the stock. Everybody's talking about how hot it is. All of a sudden the stock or whatever starts going down. Then you decide to hit for the doors too, like in a fire sale. If you know the company and you understand what it is that you're investing in and you stick to your core principles that you're learning, okay, you will be able to hold that position. You won't be selling and dumping, taking huge losses like everyone, and you won't be going in and averaging and losing money because you're averaging at the wrong time. You'll understand what's taking place. Now, don't get me wrong. I believe when the stock drops in price, I believe in averaging. But I only do that in the companies that I know, that I understand, that I know what's happening in the industry. I know what's happening in the company. So make sure you understand this, okay? We're going to get back to the video because he's sharing some really good stuff, especially for those who like to trade stocks all the time. This is really good stuff, people.
You're now seeing yourself as the lesser self as dictated by this balance. And that then pressurizes you into trading bigger again on what looks like a sure thing. But now you're punch drunk because you must find an opportunity quickly. And it's not a sure thing. It's the first thing you grabbed hold of that best represents a possible trade. So you're then bastardizing your criteria to grab hold of something that you expect to leverage you back into where you once were. This is a very big fatal spiral because once again you then overtrade because you've got to make back more to get back up, and that's the recovery ladder concept, and boom, that is probably the single most destructive that sees someone have a £10,000 account reduced to a few hundred or £1,000 and then virtually giving up, realizing that they've blown it. Size.
It's 91% of people are in that sort of category.
I wouldn't say 91% are in that category. They don't all blow their accounts up from £10,000 down to 9, but they aren't possibly consistent with money management as a whole. And sizing is one element of money management. Don't forget, I said risk reward should be central to that as well. So they're taking trades that aren't worth the squeeze. The juice isn't worth the squeeze. And the probability of win rates, they haven't tested what likelihood they have of winning. Too tight a stop, something else I've mentioned. All of those things all fall under the larger money management cluster. And those are all key.
Guess who else did that with?
So do you agree with this statement? The only way to make money is slowly and steadily, over time, not trading Forex indices, commodities, etc., because they're a giant casino.
No, I wouldn't agree with that statement at all. Those underlying markets can be traded profitably on a consistent basis. There isn't an efficient market hypothesis that truly keeps everything at true value. Anything that involves people will have reactions and overreactions and underreactions. So no, I think you can. I think I wouldn't be in the game if I didn't feel that there was an edge that could be taken.
Hey, is it the right management team? What are they doing? Okay. Do they have the track record? Are they reinvesting their monies back into their company for growth? Okay. You got to know these things, people. Are other investors coming in, institutional investors, things like that, coming in? These things are critical. Does the company, very important here, does the company have an opportunity for double-digit or triple-digit growth? I like triple-digit growth. So if that's my model, if I see something with double-digit growth, guess what? It doesn't fit the model. I'm not doing it. That doesn't work for me. So before I invest in another stock, I'm going to play that rules back to myself and wait, stop, hold, whatever you want to call it, and I'm going to review those rules, and then I'm going to see the next stock, does it meet those particular rules? And if it does, then I move forward with an investment in that company. Again, you're not going to get every last one of them right, but you'll get the majority of them right. The majority of them, they'll be right. And your big ones, you're probably only going to get 3 or 4 that's going to really hit it out the park for you, but they're also going to take your overall average portfolio way, way over the top, okay? So let's keep that in mind. That's what he's talking about. When you make a bad decision, your first bad decision was you bought a stock, you didn't understand it or anything about the company or industry and things of that nature. The stock did something that you weren't expecting. You dumped out of the stock, which was your second bad decision, is that you jumped out of the stock, okay? You just bailed on it for whatever reason, negative press release, or everybody starts selling, or it dropped below a certain threshold point that you may have had set. And I don't know how you can set a threshold up or down if you didn't do the basics in the first. See, if you got a rocky foundation, people, the whole thing stays rocky. You got to do the first things first. And then if you had done that, then you'll know, oh, okay, it's going through something. Oh, I know to accumulate, average a little bit more. I don't have to panic, all right? But you only know to do that when you know the company, you know the industry, you know the management. The management is reinvesting in the company. The company has the potential for triple-digit growth. That's when you know, oh, okay, it doesn't matter what the stock's doing. I'm not looking at the stock. I'm looking at what's going to happen. Very important. Minority business access. I hope we've been able to bring you some value today and sharing the information that we have shared with you. Again, people, minority business access. I hope we've been able to bring you some value today. Sharing the information that we have shared with you. My team's doing a really good job going out and getting other information for you to take a look at, to give you a more diversified and a more round view of what it is that we look at, how we look at it, you know, so we're really excited. If you have any questions or anything of that nature or want to learn more, reach out to my team at solomonrcali.info. Again, reach out to my team at solomonrcali.info. And hey, don't forget, I got a book coming out in 2021. You could read the book. It'll guide you through all the minefields and help you to get to the other side so that you can do and figure that out for yourself, what is best for you, so you'll have your own winning strategy. Thank you so much for tuning in to Minority Business Access. See you soon.
You've reached the end of another episode of the Minority Business Access Podcast. Connect with us at solomonrcali.info to leave a review and access more resources. We hope you enjoyed this show and found great value. See you at the next episode.